But here's something new. We at ET now are creating the endeavor of new innovations for our viewers. And this time, we've got an exclusive tie-up with ProAlpha Systematic Capital, where experts from their team will design a portfolio for viewers, and they will be reviewing the same on a consistent basis as and when the need arises. Firstly, let's take it across to Pankaj Podar, my research colleague, to give a gist of this exclusive property. Pankaj?
Right, Aisha. So as you pointed out, it's going to be a portfolio that ProAlpha Capital will make for our viewers, and this will be launched today. This will have stocks that they would be recommending with weightages as far as the portfolio is concerned. On a periodic basis, they would be coming back to our channel as well as reviewing what's happening on this. Do you need to reduce the weightage? Do you need to add the weightage, or do you need to add the stocks at that point of time? Now, this is not a very common portfolio or a portfolio, as you know, a lot of fundamental guys say. The unique feature about this portfolio is that it's a mix of fundamental as well as technical reasons. It clearly looks into the long-term growth stories. It will have long-term large cap stocks as well as quality mid-cap names. At a point of time, 11 to 15 stocks is what they usually recommend, but initially they would start with 5, and then they would keep adding it on, as well as this portfolio will be well diversified. If you look about ProAlpha Capital, it's one of the largest managed futures fund here in India. Only F&O manager in India to be regulated by US regulators. They are managing and advising close to AUMs of about 1,000 odd crores, and they are both funda as well as technical mix. So that's the unique feature about this entire portfolio.
Okay, Pankaj, thank you for that quick introduction. Let me now connect with Rishi Kohli, CEO of ProAlpha Advisors. Rishi, first, welcome to the show and thank you for joining us. We're trying to build a property which could be called as a concentrated portfolio property, and it is indeed a concentrated portfolio because there are 5 stocks out there, and you're recommending that our viewers should invest 20% each in all these 5 stocks.
Right.
Now, diversification is something you should go for. Is what all fund managers, they come on a channel and they advise us.
Correct.
That diversify your wealth, never put all your eggs in one basket, but you're preaching the opposite.
Correct. No, so to be fair, I mean, typically the client portfolios we have also run in the past have diversification, and because we are a little more quantitative than most people out there in India, we take diversification to another extreme in those portfolios where we go to 30-35 stocks also. But for this, value proposition which we wanted to have here, since we wanted it to be unique, what was interesting was that we've been researching this over time where, a mix of fundamentals and long-term technicals is what works really well in some of the best performing stocks over time. And therefore this terminology which I've coined like FTQ, fundamental technical quantitative, is basically the diversification tool in some sense, because although these stocks numbers may be lower, but the idea is that wherever the long-term fundamentals and long-term technicals are in sync, supported by the quantitative portfolio tools and techniques, that is where we would zero down on.
Okay, Rishi, but just a short while back before the break, we were getting you this mega portfolio, and Rishi Kohli, CEO at ProAlpha Advisors, is still with us. Rishi, you've talked about the rationale behind picking these stocks. Now, unveil to the viewers, what are those 5 stocks that you believe are a must-have for one's portfolio?
Sure. So, this is a mix of growth and value stocks because in the current environment with volatility and uncertainty expected to be high this year and potentially next also, I find that mix even in a concentrated portfolio that it can smoothen returns. So the 5 stocks that I have are Eicher Motors, BHEL, Escorts, Sterlite Technologies, and Sadbhav Engineering. So very diversified, different sectors, different market caps, and like I said, different segments of growth and value.
2 are auto stocks. That means 40% of your portfolio, according to analysis, should be in autos, the way I look at it. And they both are different ends of the spectrum. But
right.
One is rural, second is urban.
So which is why they are both there. Otherwise, you should expect continued sectoral and market cap diversification on this portfolio as we go ahead and add stocks or delete stocks over time. But the rationale for having those 2 there is, like I said, the portfolio will be a mix of growth and value and some stocks in between as well. In Eicher's case, to begin with that, what is interesting is that obviously it's been one of the strongest performers in the last few years, but in the last 6 months or so, the PE multiples have been shrinking due to some disappointment in growth numbers, or I wouldn't say disappointment, really moderation of growth in Royal Enfield, which has obviously been the star for that stock. But what I think is being underappreciated by the market is that a lot of cities which have large two-wheeler volumes, and which are underpenetrated by Royal Enfield, there the growth has started improving and becoming stronger for the company, which would be a good trigger going forward. Secondly, there are a lot of new markets, for example, Southeast Asia and others also, which the company is entering. Then the distribution vis-a-vis, peers is still relatively low in a lot of tier 2, tier 3 towns, and that is increasing at a good pace over the last year or so and expected to improve further. And then what is very interesting is that it has made an entry into the pre-owned business. Just to give a comparison, Maruti, for example, derives 30% of its new sales from its used car True Value brand. And that is something, Eicher had not done earlier and can be also a very good trigger for this stock.
I get a sense you own an Enfield. The passion at which you're speaking about Eicher, it's only a bike enthusiast can really, describe Eicher.
Honestly,
like
I don't.
You don't.
But I'm surrounded by a lot of bike enthusiasts.
Okay. So. BHEL. Now, the concern with BHEL is, where is the order book? Where is the government capex? What is happening to the power sector? And they've not really managed to upgrade their technology, and they've lost market share again to the ABBs and the Siemens of the world. I'm just taking this devil's advocate here, so that we can have a nice, interesting, interaction.
Sure. In BHEL's case, so I'll just answer, the questions you asked. But just before that, since this is a mix of fundamentals and technicals, I'll highlight what is the most interesting thing about this stock, which is slightly from a technical quantitative perspective, which is that, it's been languishing at almost all-time lows for a long time. And it's just started, rising from there as we speak. So what is very interesting is that the downsides are really, really limited. You wouldn't probably see it going below 75, 77 kind of levels. It's hardly 10-15% up from there. And on long-term technicals, there could easily be a 2 to 3x kind of move over the next 2-3 years. So just on that risk reward itself, I would buy that stock even without looking at the fundamentals. But now coming back to what, the potential negatives you raised, what is interesting is that in the power sector, the company has continued to maintain its domestic market share of bagging whatever projects come up. That is one. Secondly, when you look at some of the fundamental metrics per se, obviously the sector has a lot more to do. There are more other things that BHEL can do. But just looking at the metrics, its margin improvements have been happening over the last few quarters. Profitability has been improving and is expected to improve further going by our methodology. And interestingly, Q4 is a bulk of the company's profits every year. So, as that gets delivered, potentially there's a large upside happening. The final most interesting thing is that valuation is at 60% of its historical mean, which you don't find easily nowadays. And debtors plus cash is 120% of market cap. So as those recoveries are happening, they will easily be sort of a financial leverage kind of impact on the stock, which is sort of a financial leverage turnaround kind of story, you could call it.
Sterlite Tech and the optic fiber network in Gram Panchayats, I'm given to understand, has risen sharply last 3 years, which is a big trigger for Sterlite Tech.
Correct.
The story there.
Yes, so exactly. So that, and even globally, I mean, that demand continues to be very high. Their capacity expansion has been on track. It's been going pretty well last few years. It's expected to continue. 75% of the revenues are optic fiber, 25% which is systems integration, relatively newer, smaller for the company. Also, they've been having large order wins like the 35 billion order from Indian Navy, many more such expected potential order wins in the pipeline. So as some of those happen, obviously, you never know whether they will or not, but given the traction that the company has been getting, that can be very interesting. What is even more interesting, again, like I said, focusing on the financial metrics, the ROEs and ROCs, they from early 20s last year, are expected to go to mid 30s by next year. And as we know, some of the best moving stocks would be the stocks with operating margin or ROE kind of expansions. So just on that basis itself, it's a great stock to hold.
Okay. Well, good luck. Thank you for joining us, and we'll be monitoring your portfolio with a magnifying glass. Hopefully, a market-beating performance is on our cards if our viewers they simply follow this portfolio. So follow these 5 stocks, put 20% weightage, and then we'll examine it after a month.
Perfect.
Okay. Thank you very much.